Let me start with something that might sting. If your wealth strategy depends on what's trending, you're not investing. You're being herded. Every cycle, it's the same story. Crypto booms, tech spikes, real estate surges, AI startup explosions, and millions rush in, late. Meanwhile, the wealthy are buying things no one is talking about. Quietly, consistently, without posting about it. According to the UBS Global Wealth Report, the majority of millionaires globally built wealth through diversified financial assets and business ownership, not speculative trading. That's not exciting, but it's structural. Today, we're breaking down the 7 assets wealthy people accumulate quietly while everyone else chases noise. Not to copy them blindly, but to understand how wealth is actually built. Stay with me until the end, because asset number 7 is controversial. Yet it has protected fortunes for centuries. Let's zoom out. The framework. Wealth isn't built by predicting the future. It's built by positioning yourself so that almost any future works in your favor. As Morgan Housel writes in The Psychology of Money, spending money to show people how much money you have is the fastest way to have less money. Wealthy people don't optimize for applause. They optimize for durability. So here are the 7 assets they quietly accumulate. Asset number 1. High-income skills. Think of high-income skills like a personal money-printing machine you carry with you. It's a skill the market values so highly that companies or clients are willing to pay you significantly more than average for it. It's not about working more hours, it's about having capabilities that are scarce and valuable. Before investments comes earning power. High-income skills are the ultimate starter asset. They require no capital markets, no brokerage account, no timing, just leverage. According to the U.S. Bureau of Labor Statistics, specialized skill categories consistently command wage premiums over general labor roles. Wealthy individuals often double down on sales, negotiation, coding, capital allocation, marketing, operations. Why? Because income is the fuel. 2 graduates start at $55,000. One coasts. The other invests $8,000 over 3 years into elite sales training and mentorship. By 35, one earns $80,000. The other earns $220,000 plus commission. Same intelligence, different skill asset. Charlie Munger once said, "The best asset you can have is yourself." High-income skills increase savings rate, investment capacity, risk tolerance. But income alone doesn't create wealth. Plenty of high earners stay broke for decades because they never convert income into ownership. Which brings us to asset number 2. Asset number 2. Index funds and exchange-traded funds. Let's simplify this. Imagine buying tiny pieces of hundreds of companies all at once. That's essentially what an index fund, or ETF, does. Instead of betting on one company to win, you're owning a slice of the entire market. Here's something most people don't want to hear. You do not need to be brilliant to build wealth in public markets. You need to be consistent. Data from Vanguard Group shows that long-term investors who stay invested outperform frequent traders, largely due to behavior, not intelligence. John C. Bogle said, "Don't look for the needle in the haystack, just buy the haystack." Index funds and ETFs provide broad diversification, low fees, automatic exposure to economic growth. A nurse invests $300 per month into a low-cost global ETF starting at 29. No stock picking, no trading. At 49, 6 figures invested, not flashy, but compounding doesn't need applause. But public equities are only one side of ownership. The wealthy often own something you can't buy on an app. Asset number 3. Private equity and businesses. Private equity simply means owning a piece of a business that isn't publicly traded on the stock market. Instead of buying shares of a giant corporation, you might own part of a small logistics company, a local restaurant chain, a consulting firm, a startup. You're not just an employee anymore, you're an owner. Business ownership is the single largest driver of ultra-high net worth growth. According to the Federal Reserve Survey of Consumer Finances, privately held businesses represent one of the largest wealth categories among top net worth households. 2 accountants, one maximizes retirement accounts. The other buys 30% of a small tax advisory firm. 10 years later, one has market returns. The other has scalable income plus sale value. As Naval Ravikant says, "You're not going to get rich renting out your time." Businesses break the time-income ceiling, but they require risk tolerance. If you want cash flow with tangible backing. Asset number 4. Cash flowing real estate. Let's simplify what this actually means. Cash flowing real estate is property that pays you every month after the bills are covered. Not just appreciation, not just speculation, actual income. For example, you collect $3,000 in rent. Your mortgage, taxes, and maintenance total $2,400. That remaining $600? That's cash flow. Real estate isn't magical, it's mathematical. Wealthy investors don't buy because it's trendy. They buy when rent covers costs. Debt is manageable, cash flow exists. According to long-term housing data compiled by the Federal Reserve, real estate remains a core component of household net worth growth. A couple buys a modest duplex, lives in one unit, rents the other. 5 years later, mortgage reduced, equity built, rent increased. Not dramatic, but durable. However, real estate is illiquid, which is why wealthy portfolios also include something far less glamorous. But before we move on, let's pause for a moment. Because this is where the difference between hype and structure becomes obvious. Imagine two people, same age, same salary, same starting point. Meet two engineers, Alex and Daniel. At 30, both start earning good money. Alex chases whatever everyone is excited about. 1 year it's crypto, next year it's meme stocks, then AI startups. Every cycle feels like the opportunity of a lifetime. Daniel does something far less exciting. He builds skills that increase his income. He invests steadily into diversified funds. He slowly acquires ownership in assets that generate income. No headlines, no viral trades, just structure. Alex checks Reddit every morning for the next trade. Daniel checks his automated investments once a quarter. 10 years later, Alex has had incredible wins and brutal losses. His wealth chart looks like a roller coaster. Daniel's chart looks boring, slow, almost unimpressive, until you zoom out. Because over time, boring assets compound quietly. And that's the uncomfortable truth about wealth. The biggest fortunes rarely come from the loudest opportunities. They come from the most consistent ones. Which brings us to the asset most people ignore during bull markets. Asset number 5, bonds. Here's the easiest way to understand a bond. When you buy a bond, you're basically lending money to a government or company in exchange for interest payments. It's similar to being the bank. You lend money. They pay you interest, then repay the principal later. Yes, bonds. The most ignored asset during bull markets, bonds don't excite. They are the dry powder of investing. When markets panic, investors holding only stocks panic too. But investors holding bonds suddenly have capital they can redeploy into cheaper assets. Bonds stabilize portfolios. According to historical data from Standard & Poor's, diversified portfolios that include fixed income reduce volatility and improve risk-adjusted returns. Warren Buffett has repeatedly emphasized asset allocation and risk management, not maximum aggression. Bonds provide predictable income. Cushion downturns, protect capital. During a market downturn, one investor panics and sells equities. Another uses bond income to rebalance into cheaper stocks. Same market, different preparation, but not all valuable assets sit in brokerage accounts. Some live in your ideas. Asset number 6, intellectual property. Let's make this simple. Intellectual property is something you create once that can be sold or licensed repeatedly. It's knowledge packaged into a product. Examples include books, software, online courses, licenses, music royalties, patents. You create it once, but it can generate income for years. IP scales differently. It requires upfront effort, but once created, it can sell thousands of times. Naval Ravikant again. Seek wealth, not money. Wealth is assets that earn while you sleep. A designer creates a digital template pack, spends 3 months building it. It generates $2,000 per month for years, not viral, but scalable. Most people consume intellectual property. The wealthy build it. And then, there's the asset people either mock or misunderstand. Asset number 7. Gold. Let's explain gold in the simplest way. Gold is financial insurance. It's not meant to grow like stocks. It's meant to protect wealth when currencies weaken or markets become unstable. Think of it like a fire extinguisher. You hope you never need it, but you're glad it's there. Gold doesn't produce income. It doesn't compound like stocks. It doesn't scale like businesses. So why do wealthy families still hold it? Because gold is insurance. For centuries, gold has functioned as a store of value, a hedge against currency risk, a psychological stabilizer. Central banks globally, including data tracked by the World Gold Council, continue accumulating gold reserves. Why? Because diversification isn't about maximizing returns. It's about surviving uncertainty. Gold isn't meant to outperform. It's meant to endure. Why most people miss these? Hype feels intelligent. Buying what's trending feels productive. But wealth is rarely built during emotional spikes. It's built during boring consistency. Morgan Housel writes, "Wealth is what you don't see. You don't see the ETF contributions, the bond ladder, the reinvested business profits, the skill-building nights. But you see the car, you see the holidays, you see the lifestyle, and that distorts perception." Action challenge. Build your quiet portfolio. Over the next 30 days, identify one high-income skill to develop. Automate investment into a low-cost ETF. Research one business or equity opportunity. Analyze real estate numbers, no emotion. Understand bonds, don't ignore them. Brainstorm one intellectual property idea. Decide whether portfolio insurance like gold fits your strategy. Not everything at once, but something intentionally, because clarity beats intensity. Recap. The 7 quiet assets, high-income skills, index funds and ETFs, private equity and businesses, cash-flowing real estate, bonds, intellectual property, gold. Notice something? None rely on virality. They rely on structure. Some of the financial decisions that quietly build wealth look completely irresponsible to the middle class who don't understand them. Things that seem thoughtless, unnecessary, even financially stupid. But in the next video, we're breaking down several everyday choices that many people criticize as wasting money, yet they're surprisingly common among people who end up getting rich. One of them has one of the highest returns you can get, and most people avoid it completely. You don't want to miss that one. Comment below. Which of these 7 assets are you currently building, and which one have you been avoiding? We read every comment and reply to the most thoughtful ones. If this helped shift your thinking, like the video, share it with someone chasing hype, subscribe for weekly financial frameworks, turn on notifications. Because long-term thinkers win, and quiet assets build loud freedom. I'll see you in the next one.